What's up guys, Ben here and welcome to Motivation to Invest. Ray Dalio is one of the greatest investors of all time. He started Bridgewater Associates in 1975 from his apartment, which has now become the world's largest hedge fund with over $160 billion of assets under management. He's a firm believer in market cycles and has predicted many of the previous stock market crashes. So I'm sure you'll agree there's a lot we can learn from this great investor. So in this video, I'm going to reveal the top 10 stocks Ray Dalio has purchased in 2020. Some of these stocks will surprise and may even shock you. I discovered this crucial information for you guys by delving deep into Bridgewater Associates 13F filings. These are quarterly reports which all financial institutions must submit when they have over $100 million of assets under management. So if you're ready to discover what Ray Dalio has been buying and see if these stocks are right for you, then let's dive in.
Coming in, flex, I just wanna win.
Welcome back guys to Motivation to Invest. Before we get started, go ahead, smash that like button for the YouTube algorithm. That allows us to continue creating more great content like this for you guys. In addition, if you would like more investing tips and exclusive stock market picks, which I personally have invested into, then you should definitely subscribe to this channel. Be sure to turn the notification bell on. That way you'll get notified when I release future stock picks. With that being said, let's get into the video. Right guys, so here we are, the US Securities and Exchange Commission for Bridgewater Associates. So if we click through, we've got all the companies and all the stocks which are held by Bridgewater Associates. So if you want me to do another video in the future showing you exactly how to analyze the 13F and find the new holdings which have been purchased, then just comment below and I'll get that sorted for you guys. So let's get into the list. Let's get into the top 10 purchases. Number 10, we've got Fidelity National Information Services. Bridgewater Associates paid $4.1 million worth of shares, and it makes up 0.1% of the portfolio. So let's click through. Let's find out about this company. So this is a financial services company, payment service provider, provides credit and debit card processing, electronic banking, risk management, check cashing, merchant card processing transactions to financial institutions and merchants. So it's a financial services company basically. This is their website. $9 trillion moved around the globe annually, 75 billion transactions processed around the globe, and over 20,000 clients. Let's dive into the numbers of this company. So I'm over here on Stockopedia. I did another video on this platform, but basically this is one of my favorite stock screening platforms at the moment because it allows you to research each individual stock. Each stock's given a stock rank, which is ranked in terms of momentum, value, and quality. So it just basically allows me to look at the stock market and look at individual companies and find out, is it a good purchase or not, and what's wrong with it and what's right with it. So if you're interested in finding out more about this platform and how you guys can use it, I've actually been given an exclusive 25% off discount voucher, which if you click the link below in the description, you guys can click through to Stockopedia, and if you sign up to the platform, you'll get 25% off. Now this is exclusive for the viewers of Motivation to Invest only, so it's exclusive for you guys. It's not everyone can do this, and not everyone can get this discount. So I'm not sure how long it's going to be available for. So if that's something you're interested in, click through and see if the platform is right for you. So having said that, let's dive into the numbers. So Fidelity National Financial Incorporated, stock rank of 92, which is very good. Momentum 70, value 80, quality 79. So it says at the moment it's a good value stock. Let's look at the numbers. Very slow growth, 1% compounded growth rate over the past few years. It's very, very slow growth. It's predicted the revenue is predicted to decrease for 2020, increase again slightly for 2021. Operating profits are much better, 22% compounded annual growth rate. Dividend growth, which is very good. So it's good to see that the dividend is growing. It's always a good sign in companies. So yeah, here you can see the revenue. It's reported to decline for 2020 and then increase again for 2021, obviously due to the global issue. Similar with net income and earnings per share. Let's look at the analyst consensus. Now, this is one of my favorite features of Stockopedia. It's basically got stock analysts from all over the world. So you've got people from Barclays and usually has people from JP Morgan. And they analyze the stock and say whether it's a good buy or a good sell or whether you should hold. So here it says 2 hold, 4 buy, 1 strong buy. Let's look at what we got here. Current ratio not available. Return on capital 10.4%. Price to book value okay, average I'd say. PE ratio 11.8. That's pretty good, to be fair. That's quite a good valuation. So discounted cash flow calculation, we can see that it's share price versus its fair value. So according to this calculation, which discounts the cash flows back from the predicted revenue growth, it says it's 5.2% overvalued, which means it's sort of about right. It's a little bit overvalued. Let's look what else is interesting here. So yeah, here you've got the balance sheet. Short term, slightly more assets and liabilities, which is okay. Long term, a lot more assets and liabilities. Okay, insider trading. Now this is something you always want to check up. And you don't really want to be seeing a lot of sell-offs. So there's been, I'd say, a sell-off here, 174k. Key fuse on the 27th of May 2020. Now, in the grand scheme of things, that is not a massive amount, so I wouldn't worry too much about that. But there has been a lot of previous sell-offs in the previous year, 2019. So that's not a massive amount in the grand scheme of things. But let's see who this guy is anyway. Key fuse, is he on the board? Because this is always important. So he is on the board. He's the independent director. So that is a sort of crucial factor, because if he believes that the share price is currently overvalued, and he sold it off at $137 actually, so he was correct in doing that, then that's why he sold off. It doesn't mean he's lost complete faith in the company. Honeywell International is a multinational conglomerate, technology manufacturing company, 4 segments: aerospace, home and building technologies, performance materials, safety and productivity solutions. Stock rank 84, very good also. Momentum 93, quality 82. The value score is very low, which means, according to this software, it says it's slightly, it's got a slight higher valuation at the moment. Total revenue is forecasted to decline slightly for the year 2020-2021, which isn't a good sign. It's due to the global issue I'm expecting. 5.38% compound annual growth rate on the operating profit over the past few years. Increasing operating margin, it's a good sign. Dividend growth increasing, that is a very good sign. So yeah, here's the issue here. Revenue predicted to drop for 2020-2021. Net income, earnings per share. What else have we got here? Current ratio 1.3. So the current ratio is the company's short-term assets to short-term liabilities. So what you want to be looking for is how many times the company can pay off its liabilities. So this says the company could pay off it 1.3 times. And you want to be looking for definitely anything over 1, 1.5, upwards, 2, even greater is always a good score. This is average, I'd say. Price to book 6.4, PE ratio 21. So yeah, okay company, slight high valuation at the moment. Let's move on. Coming in at number 8 is Abbott Laboratories. Abbott Laboratories is an American multinational medical devices and healthcare company. So it was founded in Chicago in 1888. Sells medical devices, diagnostics, branded generical medicines, nutritional products. Split off from research pharmaceutical company AbbVie in 2013, so you might have heard of them. So they're also doing antibody tests for the recent virus, which has probably seen their share price rise, I can imagine. So we're here on Abbott Laboratories. It's got a stock rank of 81, momentum of 86, value 25, quality of 94. So another fantastic stock. As I expected, the stock prices have risen massively, as many medical companies and pharmaceutical companies have. Also, it's involved in the antibody testing for the virus. So that's why the stock price has risen here. The value, of course, the value score is very low at the moment, which means it's got a high PE ratio, which is not a good sign. Valuation's a little bit high. Call this company a slow grower. It's got very slow, steady revenue growth, 9.52% compounded annual growth rate, operating margin 12.1%. Revenues are forecasted to increase though for 2020 and 2021, and net income and earnings per share. So they're all great signs. Analyst consensus. So we've got Deutsche Bank here, Goldman Sachs, JP Morgan, Morningstar. 1 say sell, 3 hold, 9 buy, 7 strong buy. So to the stock market analysts, it is a strong buy. Current ratio 1.4, which is good. So yeah, great company overall. Slight high valuation, but that's expected. Insider trading, there's been a few sell-offs though, so they must also agree that the share price is overvalued. Randall Woodgrift, $93 a share, sold off $347,000 worth of shares. 25th of Feb, there was a small sell-off, and 2nd of August, that was in 2019. Getting into number 7, S&P Global Incorporated. $4.3 million worth of shares, making up 0.1% of Ray Dalio's portfolio. So S&P Global, these are Standard & Poor's, leading index provider and data source of independent credit ratings. So you might have heard of these with regards to the S&P 500 index. So they collect a lot of data and they help to create these indexes. Index providers make their money by licensing their indexes to investment firms to create financial products. So that's how this firm makes money. So it basically provides a license for its products, such as the, say, for example, Vanguard S&P 500 ETF. Stock rank 90, momentum 98, value 25, quality 99. So yeah, then again, another amazing, very good company, just with a high valuation. So approximately $208 a share before the crash, dropped down to $192, now up to over $331 a share. Another slow grower, 5.8% compounded annual growth rate. Slight decrease in revenue predicted for 2020, increase for 2021. The increase, dividend growth increasing. So these are great dividend stocks from what it seems, with a lot of Ray Dalio's purchases. Sort of nice, steady dividend, reliable companies, strong balance sheets. So their forecasted revenue growth, net income growth, and earnings per share growth. Analyst consensus, 4 say hold, 7 buy, 4 strong buy. Right guys, so diving into stock number 6, we have Accenture PLC. This purchased $4.5 million worth of shares, making up 0.1% of Ray Dalio's portfolio. Accenture is basically a professional services company, so they do strategy, artificial intelligence, cyber resilient businesses, blockchain, cloud computing, future workforce. So provides professional services mainly in the IT industry from what I can see here. So this is another great stock. Stock rank 90, momentum 91, value 33, quality 98. So great stock overall, high valuation again. So $200 a share before the crash, dropped to $149, back up to $211. Slow growing company again, 6.28% compound annual growth rate, operating margin, increasing dividend. Yeah, so another great dividend play. Forecasted revenue increase, net income forecast to increase, and earnings per share. The analysts love this one as well. 8 hold, 13 sells, 6 strong buy. Only one that says sell. High valuation 26.6. Looking at the DCF, 25.7% overvalued according to this calculations here. Right guys, so diving into number 5, PepsiCo Incorporated. Now this is a company we all know. Purchased $4.5 million, making up 0.1% of Ray Dalio's portfolio. PepsiCo brands, you've got Mount Dew, you've got Aquafin Water, you've got Pure Leaf. You've got Lipton iced tea, so it's got a variety of brands. It's not just Pepsi. Obviously, you've got Pepsi there. All these brands are involved in the company. So it's just sort of staple products which you'll tend to purchase. Even you've got the Starbucks Frappuccinos here, Rockstar energy drinks, even a few protein shakes. What other products it's got here? It also does Quaker Oats, Lay's crisps, or chips as you might say in the US. Naked smoothies. There'll be a competitor for Innocent Smoothies, which Coca-Cola owns. It's quite ironic really that these companies, which were generally associated with being unhealthy, have now just purchased the most healthiest sort of health brands for drinks and snacks. Balance these guys out. They also own Muller Greek yogurt from what I can see there. Tropicana. Yeah, a whole bunch of products. Let's look at the numbers. PepsiCo. Stock rank 91, momentum 88, value 40, quality. So then again, another fantastic company. I'm assuming a lot of people have been snacking over lockdown. Compounding annual growth rate, very, very slow, 0.13%. So yeah, this is a slow grower. But I believe Ray Dalio pitched this because of its nice dividend. 8.41% compounding growth rate on its dividend. So its dividend's currently around 4.78 now at the moment, which is fantastic. Revenue forecasted to increase for 2021, slight decrease for 2020, surprisingly. Income forecast to increase and earnings per share. Broker consensus 7 hold, 8 buy, 4 strong buy. Current ratio 1.1. Could be a little bit higher, but a company like PepsiCo, I can't imagine it going under. P/E ratio slightly high, 23.7. So yeah, PepsiCo, great company, nice reliable dividend. In terms of my personal investing style, it's a bit too much of a slow grower for me. Number 4, Philip Morris International. Wow, okay. So this $4.9 million worth of shares purchased, 0.1% of the portfolio. So this is a company which, of course, you know, does the cigarettes, and it's very, I'd say, out of flavor at the moment, especially in the developed world. But I'm assuming a lot of these companies are looking at emerging markets. On emerging markets, here we go. Tobacco giants fume over claims they exploited to do the virus in Romania, Greece, and Ukraine donations. So, yeah, it's not exactly the most popular stock, but maybe Ray Dalio knows something that everybody else doesn't. And I can imagine in emerging markets, any company which is selling an addictive product will increase its sales. So there you go. Stock rank of 98, momentum 87, value 72, quality 97. So it says it's a fantastic company. Value is not too bad actually because it's out of flavor. So metric wise, it's actually a great company to purchase. It's just whether you want to be involved in a cigarette company. Me personally, ethically, I don't really want to get involved in them, to be honest. But if you just care about the profits, it's not a bad company at the moment from the looks of it. Share price $75 a share. Before the incident, it was around $88. Slow grower again. 0.026 compound annual growth rate. Slight operating profits decline. But yeah, dividend increasing. So yeah, nice dividend plays. 4.62%. Forecasted revenue, $30 billion for 2021. Net income forecast to increase and earnings per share, all for 2021. Analyst consensus, 4 hold, 9 buy, 4 strong buy. So yeah, fantastic company. Current ratio could be a little bit higher. P/E ratio 15. So fantastic company, not a bad valuation. Great overall on the numbers side. It's just whether you're ethically inclined in that way where you want to purchase a stocks in a cigarette company. Me personally, it's not my style, but it does have a great dividend. So it's just something to think about. On to the next. We're now into the top 3. Lockheed Martin Corporation. Ray Dalio's company, Bridgewater Associates, purchased $5.2 million worth of shares, making up 0.1% of the portfolio. one of the largest companies in aerospace, military support, security, and technology industry. So I can imagine these guys have a lot of government contracts. Here we go. NASA and Lockheed plan to start X-59 jet flights, starting testing next year. Stock rank 93, momentum 93, value 45, quality. So yeah, another great company there. Not bad, to be fair. Share price 414. Before the crash, it was 427, so still a slight discount if you look at it from that point of view. Still a slow grower, but better growth rate than the previous companies we looked at, 8.41%. Revenue growth here. Operating profits are also growing. Another great dividend play. So it's got a 9.2% dividend there from what I can see. And it's been increasing 10.4% on a compounded annual growth rate. So great dividend play, Lockheed Martin. Revenues forecast to increase, net income and earnings per share. So yeah, what can I say? Great company overall. Brokers, 9 hold, 7 buy, 6 strong buy. So current ratio 1.2. P ratio 16.5. So not a bad valuation considering the industry. Definitely one to watch if you're after just a nice dividend play at a nice valuation. Yeah, definitely one of my favorites there. We're getting into the top 2. McDonald's. Okay, McDonald's. We all love McDonald's. They've been obviously shut down over the lockdown period. Now a lot of them are reopening. The reopening first as drive-thrus and then obviously the full restaurant. It's obviously a company which has been known for its unhealthy food in the past, and I think they're trying to align themselves with more healthy, maybe even vegan food, vegetarian, trying to just sort of get with the times a little bit. So key pillars of their growth strategy are to retain the existing customers they have, extending areas of strength on the breakfast and family occasions. So retain the customers lost by improving the taste and quality of our food, enhancing convenience and offering strong value. Convert casual customers to more committed customers with coffee and snacks. So they're trying to retain, regain and convert. That's their plan for growth. Free accelerators, digital. So they're going to be using a lot of obviously digital technology, takeout, drive-through, delivery. They've obviously introduced delivery now, which is, I've just wondered why it took McDonald's so many years to introduce delivery. To me, it's been a no-brainer for 20, 30 years. Experience in the future of the US. So they want to elevate the customer experience in the restaurants through technology. That could be something interesting to look at. So yeah, let's look at the facts and figures. So stock rank 77. 66 momentum, value 39, quality 95. So, surprisingly, the value score is not that great. Considering a lot of the restaurants closed, I'd say the share price is quite high. It's a bit optimistic, really. It's $197. $197 before the incident. It's back to the same, and in the UK anyway, lockdown's still on. Compounding annual growth rate minus 5.4. So revenues predicted to increase for 2020 as expected due to the lockdown global issue, increasing again for 2021, increasing in profits. But really with this stock, you're paying for that brand. The McDonald's brand is so powerful. That's its moat, that's its competitive advantage. Dividend is obviously increasing nicely. 7.6% compounded annual growth rate on the dividend. So yeah, another strong dividend play. Revenues forecast decline 2020, up back to 2021. Net income, earnings per share increases. Analyst consensus 10 hold, 16 buy, 9 strong buy. P ratio 30.8. Yeah, so great company overall, high valuation. In terms of the restaurant space at the moment, I believe there are a lot of great deals in the restaurant space, which you can definitely pick up at the moment. Number 1, ready? United Health Group Incorporated. Who would have thought it? A health stock, of course. Ray Dalio, $5.5 million worth of shares, making up 0.1% of his portfolio. So United Health Group. So it's a managed healthcare company based in Minnesota, healthcare products and insurance services, the largest health company in the world by revenue of $242 billion. This is a giant of the healthcare industry. And here are 3 numbers that make the stock a buy according to this article here. So it's got great bottom line growth, earnings per share increasing from $6 a share in 2015 to $14 of last year. Expanding customer base. In 2019, United Healthcare served 49.15 million people, up from 46.4 million people in 2015. The company added 845,000 new commercial customers, along with 325,000 new Medicare Advantage policyholders. It's also raised its quarterly dividend 20% last June to $1.08 per share, giving it a stock yield of 1.5. United Healthcare has raised its dividend every year since 2010, and in that time the annual payout has increased at a compound annual growth rate of 30%. Stock rank 90, momentum 95, quality 81, value 47. Yeah, so another fantastic company. 13.2% compound annual growth rate. That is incredible for a company of this size. It's forecasted to have the revenue increasing, the net income and earnings per share all increasing. So fantastic company. 4 hold, 12 buy, 9 strong buy. Dividend, yeah, there you go. So from the other article, it said 30%. This software's worked out from these few years here. From 2014, it's increased its dividend from 24.1% compounded rate, which is fantastic. So yeah, great company, great dividend play. The increase on healthcare spending is obviously going to continue increasing. P ratio 18, it's not bad, to be fair, for a company in the healthcare space. So United Health, if you want some exposure to the healthcare industry, check out that stock. So what do you think of the stocks Ray Dalio has been buying? Comment your thoughts below. Also, if you found this video informative, please smash that like button. That really helps us out with the YouTube algorithm. And with that being said, I'll see you guys next time.
Coming in, flex. I just wanna win, LABB who we running with, coming in, flex. I just wanna win,